Hey everyone. So today we're going to have a free course on options trading. We're going to learn the basics of calls and puts, but we're going to start with puts because I think they're the easiest to understand. My name is Ben and I have a master's degree in finance and I'm going to be doing this lecture for you. All right, so what is an option? Well, we're talking about stock options. And options are contracts and they're derivatives because they derive their value from something else. They derive their value from stock. So there's two kinds of options basically. There's calls and there's puts. You can buy them and you can sell them. So in total we have four possibilities. We could buy a call, we could sell a call, we could buy a put, and we could sell a put. Now in this video, we're going to be talking about selling puts. I think it's the easiest to start with and the easiest to understand. And honestly, if you understand selling puts, you understand buying puts. Calls are a little bit harder, but that'll be for another video. And an important thing to know is that one option contract is tied to 100 shares of stock, always unless stated otherwise. All right, so what does the option contract do? The options give the owner of the contract the right but not the obligation to buy or sell a specific number of shares of stock at a specific price on or before a specific date. Now, the specific date is called the expiration date. That's the day the contract is going to expire. And the specific price is the strike price. And the specific number of shares depends on how many options contract you have. You got one contract, you got 100 shares. Two contracts, 200 shares, three contracts, 300 shares, etc. All right, options are just 1 to 100. It's just the way it is. All right, so here's a super basic overview of what an option is using an analogy on ships sailing across the ocean. So let's say you got a ship with a lot of cargo sailing across the ocean. It might sink. So the shipping company, they're going to buy insurance in case it does. The cargo, say it's worth $10 million. So the shipping company is going to pay $1 million up front for insurance. So the insurance seller gets $1 million. The insurance buyer has to pay $1 million up front. Now, if the ship doesn't sink, the insurance seller gets to keep his $1 million. If the ship does sink, then the insurance seller has to pay out $10 million and secure, the value of the cargo as agreed upon in the contract. So we see that the buyer has to pay the insurance premium to the seller up front. The seller of the contract gets to receive the insurance premium up front. And the person who's selling the insurance is hoping that he doesn't have to fill or exercise the contract. Okay, so here are the important terms that you need to know if you're going to trade options. Right? Just remember, one option contract has 100 shares of stock tied to it. A strike is the strike price. That's the price of the stock that'll determine the transaction. Whether any stock is bought or sold depends on the strike price. Very important. The premium is like the insurance premium. It's the amount of money that the insurance seller gets for securing the price of the stock at the agreed upon strike price. And here's what you got to know. The buyer of the option has to pay the insurance premium, and the seller of the option, they get the insurance premium. And this all happens immediately once the option contract is bought or sold. The expiration date is the last day the contract is valid for. And exercise simply means to fill the terms of the contract, right? And go through with the transaction. All right, so where do you find the options contract? Well, the options contract, or the list of options contracts, plural, is found on the option chain. So you're going to go to the stock that you want to trade, like in this case it's Tesla. You're going to click trade options, and there you go, you have an options chain. Now we're going to look at an example of selling a put. So you see all those things going across. Let me turn on my pointer here. You see all these things going across. These are, you can all think of these are different options contracts, right? So we have over here selected sell, put. This is the expiration date. The share price, that's in the center, that's the current price, of Tesla stock. And over here, you got the bid. And the bid just means how much insurance premium you're going to get for selling the contract. Or if you're buying the contract, it's how much insurance premium you got to pay. Okay, and here's an important thing, the strike price. Okay, it's all on the side. And so going across here, we've got one option contract, and I've made it larger so you can see here. We got the strike 240, bid, or that's a premium of $44.40, and this is all per share, right? This is a $240 per share, $44.40 per share, and over here you have the break even going down. Okay, so also the computer gives you like an estimation of if you're going to make money from this. It says chance of profit, but that's really just it's only for reference. Don't take that with a grain of salt. Okay, so I'm going to repeat myself here because I really want to make sure you guys get this. If you're selling a put, just think of it like selling insurance. Okay, so for selling the insurance, you get paid insurance premium. If you're buying insurance, you got to pay insurance premium. Okay, just think of it like car insurance. So the terms of the insurance contract says that you, the insurance seller, will buy the stock from the person who bought your insurance at the agreed upon strike price if the stock they bought insurance for drops below the strike price. This is what put options are. The number of shares you insure depends on the number of contracts you sold. And another thing to note is that writing a contract is the same thing as selling a contract. Right? If you're writing a put, selling a put, it's the same thing. Writing just means, because back in the day, they used to write these things on paper. Now it's all digital. So let's say you sold 4 contracts on Tesla stock. That means you're insuring 400 shares of Tesla stock because one contract is 100 shares. 2 contracts is 200 shares. You sold 4 contracts, you're securing the price at the strike price for 400 shares of stock until the expiration date, and in exchange, you get paid money called premium, right? And the amount of premium you get really depends on how far into the future the contract will expire. The further into the future, there's more uncertainty, hence you get more premium. All right, so let's look at an example of selling one put contract on Tesla stock, right? So here's a strike, $240 a share. Here's a premium, $44.40 a share. And the expiration date is June 20th, 2025. So if we sell one put on Tesla within these parameters, here's what's going to happen. You're going to secure the price of 100 shares of Tesla stock at $240 per share until the expiration date of June 20th, 2025. To sell one put, you need $24,000. It's called a cash secured put because remember, one contract has 100 shares. So 100 times the strike over here, let's give you $24,000. That's the amount of money that you need to have to sell one put according to this contract, the rules of this contract. And you will get immediately, upon selling this contract, $44.40 a share times 100. So you're going to get $4,000 and $440. You get this right away. If the stock price of Tesla never drops below the strike of 240, you just get to keep the premium. You just get to keep your insurance premium. You get to keep the $4,440. That's what we hope is going to happen, right? If you're selling the put, you're hoping the price of the stock, the market price, from the day you sold this contract until the day it expires, is going to stay above the strike. All right, that's how we're going to get the money and not have to do anything. Now, unfortunately, if the stock price of Tesla falls far below 240, then the buyer, the guy who bought the insurance contract, is going to exercise, most likely, the contract because it's going to be profitable for him to do so. And you're going to have to pay him exactly what it says, $240 a share for 100 shares of his Tesla stock. And please note that he can exercise his contract if it's profitable for him at any point in time until the day the contract expires. All right. So, okay, let's calculate what happens if the market price falls below the strike, right? So remember, we secured the price at 240, and let's say hypothetically, Tesla's having a manufacturing problem or recall. It's all hypothetical, and the stock in the future drops to 120. Okay, that means the put buyer, the guy who bought the insurance, is going to exercise his contract because it's profitable for him to do so. So what's going to happen is you're going to have to pay him $240 a share for the 100 shares that you agreed to secure. You now have 100 shares of Tesla, worth at 120 a share in this hypothetical situation. But you also got the insurance premium. So just calculate everything. 120 times 100, 12,000. 4440 times 100, 4,440. Add those two up, and we get the 16,440. So we started with 24 grand. Now we got 16,440, and we got a loss of 7,560. But wait, listen, it's not over. Since you own the stock, you own Tesla stock now. That's not bad, right? It's a good company. So what we can do is we just hope the price recovers, and we wait, right? And now this is a hypothetical situation, but in most cases, if it's a good company and you don't mind, owning the stock of that company, it's not necessarily a bad situation, especially if, your loss isn't so heavy. This is just an example of it, almost halving price, but typically the stock might just decrease a little bit, and it probably will recover. All right, so in summary, selling puts is like selling insurance. If you're buying a put, it's like buying insurance, okay? This is the easiest way to understand it. In order to sell the insurance, you need the cash to secure the contract. And if you want to buy the insurance, you need the underlying stock to secure the contract. So the put sellers, they're going to need cash, and the put buyers, they're going to need stock. Okay? Remember, everything is 1 to 100, so one contract is 100 shares, always, 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 unless stated otherwise. And just remember, the put seller is honestly hoping that the market price of the stock always stays above the strike until the contract expires. And if that happens, they get to keep the premium, they don't have to pay anything out, and that's ultimately the best situation for them. In the next video, we'll talk about calls, and I really hope you guys learned something.